In this video, we're going to talk about the circular flow by economic sector. The circular flow has four main economic sectors. The first one is households, followed by business firms, then governments, and then the foreign sector. Each one of these four sectors have both earnings and expenditures. So, let's begin with households. So what are households? Households are the individual consumers of final goods and services. If you are an individual consumer of a final good or service, you are considered a household. So, they have, like I said, both earnings and expenditures. Their earnings are going to be the personal income. That's going to account for wages, salaries, proprietor's income, rental income, dividend and interest payments, as well as transfer payments. Transfer payments are often seen as social welfare payments. These are your unemployment checks. These are your disability checks, and those social welfare type payments would often go into these transfer payments. So that accounts for that personal income. So whenever we're talking about the circular flow, we're actually looking more at the disposable personal income for an individual household. Well, what is their disposable personal income? Well, very simply, it is their gross income, so the total amount that they receive in, say, wages and salaries, proprietor's income. What is the total amount of earnings that they receive within this year, minus the contributions to social programs and taxes? So whenever we talk about disposable personal income within the circular flow, what we're talking about is the total income for all households minus all households' contributions to social programs and to taxes. So we do have disposable personal income on an individual household sector, but in this case we're actually talking about it on the whole macroeconomy, the whole United States, the whole nation disposable personal income for households. So whenever we're talking about this, we're talking about all of the households, all of the households' gross income, minus all of the contribution to social programs and to taxes. So this is their earnings then. So their expenditures are called personal consumption expenditures. These are payments on all final goods and services, both durable and non-durable. So we have a durable good and a non-durable good. A durable good is a good that typically lasts you 5 to 10 or more years. So a durable good are often considered cars, washing machines, refrigerators, barns, some of these big items that you expect to last you quite a while. Then you also have non-durable goods. Non-durable goods are often your food products, because do you really expect your food products to last you 5 or 10 or 20 years? No, you don't. So non-durable goods are stuff like your food products, your clothing, something that you ultimately look like you're going to use up within a couple of years. The second main economic sector are the business firms. The business firms consist of all firms other than sole proprietors. Sole proprietors, as you know, are the people who own and operate their own business. They own their own business. There's only one person or one household that is owning that business. Well, whenever that's the case, they actually fall into the household section. Just like we saw right here, we said proprietor income. If it is a sole proprietorship, it's actually included in the household. So when we talk about business firms, we're talking about all firms other than sole proprietors. These could be corporations, it could be partnerships, or anything of that nature. So, just like we had in households, we have both earnings and expenditures within business firms. Our earnings are called retained earnings. These are the profits retained in the business and not paid out to the owners. So, a particular business firm might earn $100,000 in profit in a single year. Let's say firm A does. And they pay out $50,000 of that $100,000 in dividends. That means that they are taking $50,000 and paying it out to the owners of the company. The rest are being retained into the business. The other $50,000 stays in the business. Those are the retained earnings. The amount that is not paid out, the profits that are not paid out to the owners of the company. So what do they do with these retained earnings? They turn around and they use them for investments. They turn around and invest it back into the business. So, what are the expenditures of a business firm? Well, those are your gross private domestic investments. These are the purchases of all final goods and services in order to replace worn out equipment or to add to existing capital stock. So all final goods and services that are being purchased in order to replace worn out equipment, such as, say you're on a partnership of a farm and you're buying new tractors to replace old tractors. Well, that's the purchase of a final good or service in a sense, and it is meant to replace, say, an old worn out tractor. And whenever you're doing that, you're just investing back into the business. But let's say, for example, you are buying a second tractor. The first one's not really worn out, but you're buying a second one, and you're adding that second tractor, and you're adding that to existing capital stock. Well, now what are you doing? You are making an investment other than a replacement. Whenever you're investing in a business firm, or business firms are making investments other than those to replace existing worn out equipment, and they're actually adding to that capital stock, that's signaling growth within the business. Because why would you buy a second tractor if you're not growing? Well, you buy a second tractor because you think by buying a second tractor you become more efficient and more profitable and you actually grow. So whenever firms are making investments other than replacements, so they're actually adding to existing capital stock, that often indicates expansion. This expansion is indicating that there are more jobs being created, more products being created, and often signals growth of a nation as more and more businesses are making more and more investments into equipment other than replacement equipment. The next economic sector we are going to discuss is the government sector. So, whenever we talk about government, we often think of the federal government. But the federal government is not the only government out there, and it's not the only government that we include in this economic sector. We actually include all of the governments within the United States. That includes federal, state, and local governments. So, they also have earnings and expenditures. What are their earnings? Their earnings very simply are their taxes. How does a government get their money? Well, they tax the citizens. So that taxes is technically their earnings. So what are their expenditures? They're called the government expenditures. Government expenditures are all expenditures made by state, local, or federal government. Now, something to note here is that transfers between governments are excluded in these calculations. They're excluded in the circular flow. What is a transfer between governments? Well, that's, say, the federal government paying out a grant to a state or a local government, or a state government providing grants to local governments, or local governments providing grants to individual citizens, or something of that nature. Whenever they are transferring between these governments, they are actually being excluded from this circular flow. Why is that? Because it's not really accounting for the taxes again. If you were to include that transfer payment again, well, now you might be including taxes twice. Where in reality, whenever we're dealing with this, we want to only include the final purchase or the purchases of only final goods and services and the net taxes paid. So if we start shuffling money around within these transfer payments and we include all of these little transfers, well, now it makes us look astronomically larger than what we technically should be showing. An example of that is the federal government accumulates a lot of money in taxes, and they also look like they pay out a lot of money. Well, a lot of that money that they pay out are actually grants going from that federal government to the state and local government. And by them doing that, it's not really showing that we receive more taxes and that the federal and state, or the state and local governments receive a lot more money from the taxpayers. Well, that's not really the case. It was actually paid once to the federal government and then transferred over. So if we include those transfer payments, then we are double dipping those taxes that have already been paid. And we don't want to include those, we don't want to double dip. We just want to include all final goods and services being bought, and we want to include just the total net taxes that are paid. Something kind of interesting to note is that the federal government looks very large in the amount of money that they accumulate and then spend out. But a lot of those a lot of that money that they spend is not on final goods and services. They're actually these transfer payments and these social programs, and also transfers of grants and everything of that. So the federal government does not really contribute a lot to the national GDP, but whenever you get down to the state and local level, that's where you begin to see a lot of purchases of final goods and services. So in the book, they use the term, the federal government is a mouse dressed in an elephant suit, because they don't contribute as much to the GDP as what it looks like as compared to the local and state governments. The last main economic sector is the foreign sector. The foreign sector, for it to be a transaction in this sector, it must include both an American householder firm and a foreign householder firm. It must include both an American and a foreign entity to be considered part of the foreign sector. Well, just like with every other sector, we have both earnings and expenditures. The earnings in the foreign sector are called the net foreign earnings, and they are equal to income from foreign sources minus payments to foreign sources. Well, what's an income from foreign source? Let's say that an American household has stocks in a foreign company. Let's say that an American household is bought into a foreign, or say a Japanese company, and that Japanese company pays dividends to all of their owners, and this American receives a payment from this foreign company in the form of a dividend. Well, that right there would be an income from a foreign source, as an American is receiving income from somewhere else. Well, what is payments to foreign sources? Well, that very simply is, if we are an American company and we're paying out dividends and we have foreign owners, well, then we pay out those dividends to those foreign owners, to those, say, those foreign households. Then we are making payments to another country, so we are making a payment to a foreign source. So if we're an American receiving money from a foreign company, then we are receiving income from a foreign source. But if we are an American company or American household paying out money to a foreign source, or that's considered a payment to foreign sources. We also have net foreign expenditures. Net foreign expenditures are equal to your exports minus your imports. In this last video, we're going to talk about the total system of the circular flow. We've already discussed in this video the households, the business firms, the governments, and then the foreign sectors. And we've already said that each one has an expenditure and then an earnings as well. So, within the total system, we find that your total expenditures, or your GDP, needs to equal your total earnings, or your national income. So if we add up the earnings from households, business, governments, and foreign sector, all of those earnings together are considered your national income. All of the expenditures from your households, business, governments, and foreign sectors, that's your GDP. The total expenditures within the nation is considered your GDP. Well, we've already discussed in one of the last videos that GDP and national income, in theory, should equal each other. So in the total system, we find that total expenditures needs to equal your total earnings, or your total GDP needs to equal your total income, national income. So, here's the deal though. Individual sectors often either spend more than they make, or often save more than they spend, or make more than they spend. So in some cases, we have somebody with dis-savings, where they spent more than they made, and then somebody with savings, where they made more than they spent. Well, how does all that work? How can we have savings and dis-savings and still have expenditures equals earnings? Well, what happens is the total savings of one of these sectors equals the total earnings of one of these sectors. And what we have is a closed system, in that the total savings will equal the total dis-savings, and through the use of financial intermediaries, we'll redistribute that savings and dis-savings, which we'll talk about in the next video, and keeping this a closed system. So if you look down here at this chart right here, we have all four of the sectors listed. We have household, business firms, governments, and foreign sector. And then we have the same ones listed down here. So we say that each one of these are producers and consumers. And what their earnings are called, the way you read this chart is you say, all right, what are the earnings called for, say, households? Well, that is going to be your disposable personal income. Earnings for business firms are known as your retained earnings. Earnings for governments are your taxes. Your earnings for your foreign sector is your net foreign earnings. You have your spending for the households. That's your personal consumption expenditures. You have your gross private domestic investments as your spending for your business firms. Your governments are called government expenditures. And then your foreign sector is your net foreign expenditures. So this little chart right here, which you have in your PowerPoint, is probably a little bit more easy to read in your PowerPoint, kind of outlines and lays out what each one of the spending and earnings are called within the four sectors of the circular flow.